Most of the time, the biggest shifts in financial history don't arrive with breaking news banners or dramatic speeches. They slip in quietly, almost politely, while everyone else is distracted. That's why seasoned market watchers don't just listen to what institutions say, they watch when they act. Timing, not headlines, is where the real story hides. Late in 2024, during one of those sleepy stretches on the calendar when trading desks are half empty and liquidity thins out, the CME quietly raised margin requirements on precious metals futures. Then, just days later, they did it again. No press conference, no urgent explanation. Just a notice buried in market infrastructure, the kind of thing most people scroll past without a second glance. But the market didn't scroll past it. Gold dropped nearly $40 in a single session. Silver collapsed by $7, a move so extreme it would be like gold swinging hundreds of dollars in a day. That's not noise, that's a shockwave. Officially, the explanation was familiar. Market integrity, risk management, volatility control. If you've been around long enough, you've heard it before. In fact, you heard it in 2011, right before the last major precious metals cycle rolled over. Back then, margin hikes came in rapid succession, prices plunged, retail traders were flushed out, and the rally lost its momentum. So when history starts rhyming, skepticism isn't paranoia, it's pattern recognition. Some people immediately cried price suppression. Others declared the bull market dead on arrival, but both camps might be missing the more uncomfortable possibility. What if the margin hikes weren't about controlling prices at all? What if they were about controlling failure? Kevin Grady, president of Phoenix Futures and Options, offered a perspective that cuts through a lot of the surface-level outrage. According to him, margin increases aren't decided by some shadowy group flipping switches in a panic. The CME has systems in place, control committees, algorithms that monitor volatility, exposure, and risk across the clearing system. When certain thresholds are crossed, the response is automatic. No emotion, no ideology, just math. But here's the part most retail traders never see. The CME isn't the first line of defense. Futures commission merchants, the FCMs, move before the exchange ever does. These are the firms that clear trades, the ones standing between traders and the clearinghouse. Names like StoneX, Interactive Brokers, firms that don't get much attention unless something goes wrong. And when markets start swinging 5, 6, 7% in a single day, these firms don't wait around for official announcements. They raise internal margins first. Why? Because they're the ones on the hook. If a trader can't meet a margin call, the FCM eats the loss. In a calm market, that's manageable. In a market where silver is moving like a meme stock on espresso, that's existential risk. One large default, one cascading failure, and suddenly the plumbing of the futures market starts to creak. Seen through that lens, the margin hikes start to look less like manipulation and more like insurance. Not for prices, but for the system itself. This isn't about stopping a bull market. It's about making sure the clearinghouse survives the bull market. Still, that explanation doesn't sit easily, and for good reason. The pattern is stubborn. These margin increases always seem to show up during rallies, never during prolonged declines. Volatility cuts both ways, yet the response rarely does, and the timing is always curious. Thin trading days, holiday weeks, long weekends, moments when liquidity is weakest and algorithms dominate price discovery. That's when the biggest moves happen, and that's when margin rules suddenly tighten. Grady argues that this isn't coincidence, it's behavior. When experienced traders step away from their desks, speculators rush in. Algorithms chase momentum. 5% moves become 7% moves. And 7% moves in leveraged markets are not just exciting, they're dangerous. Not for the traders pressing buttons at home, but for the institutions responsible for settling trillions of dollars in contracts. But there's another layer to this story, one that makes people uncomfortable because it challenges a popular narrative. According to Grady, silver, in particular, stopped behaving like a commodity and started behaving like a meme stock. Not a monetary metal with industrial demand and centuries of history, but a speculative playground fueled by momentum, social media, and short-term leverage. That sounds dismissive until you look at the data. One of the clearest signals in any futures market is open interest. If open interest is rising alongside volume, new money is entering the market. Positions are being built. Real exposure is growing. But if volume explodes while open interest stays flat, it tells a very different story. The same contracts are being traded over and over again, in and out, flip, flip, flip. That's not hedging. That's not long-term positioning. That's churn. During those late 2024 holiday sessions, trading volume in silver tripled. Open interest barely budged. That's a red flag to anyone tasked with managing systemic risk. These weren't miners hedging production. These weren't manufacturers locking in input costs. This was fast money chasing fast moves in a thin market. Exactly the kind of environment where something breaks. Now, here's where the story turns darker and more interesting. If FCMs are raising margins before the CME, it suggests they're seeing stress before it shows up in the official data. Maybe it's concentrated positions. Maybe it's leverage stacking up in places most people don't look, or maybe it's something even more unsettling, a growing disconnect between paper markets and physical reality. Because while futures prices were swinging wildly, reports of tightness in the physical market never really went away. Delivery delays, inventory drawdowns, rising premiums. Nothing dramatic enough to make headlines, but enough to make professionals uneasy. Futures markets are designed to manage price risk, not supply risk. When physical constraints start colliding with speculative excess, margin hikes become a blunt but necessary tool. So what's really being protected here? Not prices, not speculators, the system. The clearing mechanism that everyone assumes will always work because it always has, until the day it doesn't. And that's the part nobody wants to talk about. Because once you admit that margin hikes are about preventing failure, you also have to admit that failure is a real possibility, not inevitable, not imminent, but possible. And in financial markets, possibility is enough. If you've lived through enough cycles to remember gold at $300 an ounce, you already know how this plays out. The most dangerous moves don't happen when everyone is watching. They happen quietly, wrapped in technical language, during weeks when most people are focused on holidays, not hedging. So no, this isn't just another channel asking you to subscribe. Think of it more like risk management for your attention. Because missing the next critical shift doesn't just cost opportunity, it costs perspective. And in markets like these, perspective is everything. The real question isn't whether you believe the official explanation. It's whether you understand what's actually at stake when margins rise, volatility explodes, and institutions start moving defensively. And perhaps, more importantly, when the system finally decides it's had enough, who do you think it's designed to save? That's where the truth tends to live. Quietly, boringly, right until it isn't. If you zoom out far enough, what happened doesn't look like institutions calmly building long-term positions or making strategic bets on the future of silver. It looks a lot messier than that. What actually unfolded was a surge of traders, many of them fully automated, exploiting moments when the market was at its weakest. Thin liquidity, half-empty trading desks, and a calendar full of holidays created the perfect environment for exaggerated moves. Kevin Grady laid this out in plain terms. The pattern is almost predictable now. Easter, the 4th of July, New Year's, long weekends when liquidity dries up and experienced traders step away. That's when the speculators don't just show up, they take over. And they don't tiptoe into the market. They try to move it. One oversized buy order during a quiet session can be enough to start the chain reaction. Algorithms detect the move, execute pre-programmed strategies, and momentum snowballs. What should have been a sleepy holiday drift suddenly becomes a 7% intraday swing. At that point, human judgment is effectively removed from the process. The algorithms don't care why silver is moving. They don't care about mine supply, industrial demand, or whether physical bars are tight in vaults. They see a signal. They respond. In a market as relatively small as silver futures, that's enough to turn a ripple into a tidal wave. Chaos doesn't need bad intentions. It just needs speed and leverage. But this is where Grady's explanation runs into resistance, because not everyone looking at the same data sees speculation as the main driver. There's another camp watching closely, and they're focused on something much less abstract, the physical metal itself, the bars, the vaults, the supply chain. And from that perspective, something real and structural has been changing for years. Central banks are buying gold at historic rates, not trading it, not flipping it for quick gains, buying it, storing it, and removing it from circulation. Russia, even after selling portions to fund its war effort, remains a net accumulator over the long term. China continues to add. India, Turkey, Poland, all steadily increasing reserves. These aren't retail traders chasing momentum. These are sovereign nations repositioning their balance sheets. At the same time, the supply side has quietly transformed. The large institutional sellers who used to step in during rallies and lean on prices are mostly gone. Mining companies no longer hedge the way they once did. And that wasn't an accident. Shareholders made it clear they didn't want capped upside. Investors buying mining stocks want exposure to rising prices, not stability. They want torque, not safety rails. Mining executives listened. Today, hedging is minimal, just enough to cover payroll and near-term operating costs. Everything else is left exposed to the market. That's not speculation. That's a structural shift across the supply chain. So now you have two narratives colliding. On one side, a futures market behaving like a casino during holiday weekends, driven by algorithms and momentum traders. On the other, a physical market experiencing real demand from players who don't care about daily price swings. The uncomfortable truth is that both narratives can be true at the same time, and neither fully explains the most important detail: why the futures commission merchants moved first. Remember, the FCMs raised internal margins before the CME made anything official. These firms have a unique vantage point. They see customer positions in real time, they see leverage stacking up, they see concentration risk, When they acted preemptively, it wasn't because someone was day trading silver during a holiday. It was because they saw risk building that could spiral out of control. This is counterparty risk, the kind that doesn't stay neatly contained. If volatility keeps rising and a highly leveraged trader can't meet a margin call, the loss doesn't just disappear. The FCM absorbs it. If the loss is large enough, the FCM can't cover it. Then the problem moves to the clearinghouse. Emergency reserves get tapped. If those aren't enough, the issue becomes systemic. At that point, it's no longer about silver. It's about confidence in the financial plumbing itself. And that's the kind of scenario regulators lose sleep over. That's when central banks stop pretending markets are self-correcting. So when margins were raised quietly, before headlines, before public outrage, it was a signal. Not to speculators, but to anyone who understands how fragile leverage systems can be. And if that signal felt familiar, it's because we've heard it before. April 2011 still looms large for anyone who lived through it. Silver went on an absolute tear, from roughly $26 an ounce in January to nearly $50 by late April. Retail investors were euphoric. Forums were filled with predictions of triple-digit silver. The mood was electric, almost reckless. And then the CME stepped in. Not once, not twice. 5 margin increases in 8 trading days. Each hike made it more expensive to hold futures positions. Each one forced leveraged traders to either post more capital or liquidate. The outcome was brutal and swift. Silver collapsed from the high 40s into the mid-30s in days. Within weeks, it was back below 30. The rally was finished. What followed was nearly a decade of stagnation that didn't truly break until 2020. The official explanation back then sounded exactly like it does now. Excessive volatility, market integrity, risk management, but many of those who lost money never bought that story. They believed momentum was deliberately broken, that a market moving too fast had become inconvenient. Whether that belief was correct or not, the psychological damage was real. And when margins were raised twice in 3 days at the end of 2024, that scar reopened immediately. The parallels were impossible to ignore. Another strong precious metals rally, another period of extreme momentum, another set of margin hikes during thin trading. But here's where the comparison starts to break down. The world of 2024 is not the world of 2011. Back then, central banks weren't major buyers of gold. Today, they're the dominant force. Back then, mining companies hedged aggressively. Today, hedging is minimal. Back then, institutional sellers were present during rallies. Today, many of them are absent. Fundamentally, the backdrop is stronger now than it was during the last cycle. So why did prices react so violently? The answer lies in something that barely existed in 2011, algorithmic dominance. Over the past decade, automated trading systems have come to control a massive share of commodity market activity. These systems don't think. They execute. They respond to triggers, not context. A resistance level breaks. They buy. A support level fails. They sell. Volatility exceeds a threshold. They exit. In thin markets, especially during holidays, these algorithms can feed on each other. One program reacts to another, orders cascade, and moves get amplified far beyond anything fundamentals would justify. A 5% drop turns into 7. 7 turns into 10. Not because supply suddenly changed, not because demand vanished, but because machines were responding to machines. Kevin Grady summed it up bluntly. A lot of algorithms are plugged in. When they see a move, they trade the move. The market goes wild. This is modern market structure. Efficient in calm times, dangerous in stressed ones. It creates flash crashes, sudden reversals, and price action that looks irrational because, in many ways, it is. That's the environment we're dealing with now, a market where physical fundamentals are tightening, long-term players are accumulating, and short-term price discovery is increasingly dictated by automated systems and leveraged speculation. Margin increases, in that context, aren't about killing rallies or saving speculators from themselves. They're about slowing a machine that doesn't know when to stop. The real risk isn't that silver or gold move too high. It's that they move too fast. And when speed collides with leverage, something always gives. There's a question that keeps nagging at the edges of this discussion, and it's one that neither the 2011 comparison nor the algorithm-heavy explanation fully resolves. If all of this volatility is really just a byproduct of speculators and automated trading systems running amok, why did gold get dragged into it as well? Gold isn't silver. It's larger, deeper, more liquid, and far more institutional. It's not exactly a playground for weekend traders with itchy trigger fingers. And yet, during the same period, gold didn't just wobble, it moved. Prices slid from record highs near $2,800 back below $2,700 in a matter of sessions. The move wasn't as dramatic as silver's, but it was meaningful, and that matters. Because if this were purely a story about algorithms exploiting thin markets, you'd expect the damage to be isolated to the smallest, most volatile corners of the complex. Silver, platinum, palladium, maybe. Gold should have been more insulated. It wasn't, which suggests something broader was at work, something that affected the entire precious metals space, not just the easy targets. That's where the story gets more complicated and, frankly, more interesting. Kevin Grady is right that speculation and automated trading played a role. There's no denying the fingerprints of algorithms all over those intraday swings, but beneath that activity sits another layer, quieter and more stubborn. The physical market is under stress, not the cinematic kind of stress people imagine, with empty vaults and frantic buyers pounding on doors, but a slower, structural kind. Delivery delays that never quite go away, premiums that stay elevated even when futures prices pull back, tightness in certain forms of metal that doesn't show up cleanly on a price chart. The gap between paper prices and physical availability has been widening. Not explosively, not in a way that triggers headlines, but persistently. And persistence is often more dangerous than drama. When futures prices swing violently because of speculative flows and algorithmic triggers, that gap becomes harder to ignore. Dealers, refiners, wholesalers, the people who actually have to source and move metal, see it every day. The screen might say silver is trading at a certain price, but try buying meaningful quantities at that level. Suddenly, there's a premium, or a delay, or both. Friction appears where, in a perfectly balanced market, it shouldn't exist. So when the CME raises margins and futures prices correct sharply, the paper market registers the move instantly. Charts look cleaner, volatility cools. But the physical market barely flinches. Premiums remain. Delivery time stays stretched. Because the real buyers, the ones acquiring metal to hold rather than to trade, aren't playing in the futures pit. They're not affected by margin calls, and they don't liquidate because an algorithm says so. That widening gap between paper and physical is the crack in the foundation that almost nobody wants to talk about. It doesn't fit neatly into the narratives on either side. It's not proof of a grand conspiracy, but it's also not something you can wave away with market integrity press releases. So where does that leave us? The CME says it's protecting the system. Kevin Grady says it's about reining in speculative excess. Skeptics see deliberate price suppression. Meanwhile, the physical market quietly signals that something else is going on entirely. As usual, the truth isn't clean or convenient. It borrows pieces from each explanation. Yes, there was speculative activity during thin holiday trading. Yes, algorithms amplified moves beyond what fundamentals alone would justify. Yes, FCMs and the CME had legitimate concerns about counterparty risk and systemic stability. But also, yes, the timing of these margin increases, right at moments of peak momentum during a powerful rally, follows a pattern we've seen before. And whether intentional or not, the effect is always the same. Retail traders get shaken out. Leveraged positions get forced to liquidate. Upward momentum breaks. The real question, then, isn't whether the official explanation has merit. It does. The question is whether it tells the whole story, and the evidence suggests it doesn't. Because if margin increases were purely about managing volatility, we'd see them applied symmetrically. We'd see them when gold collapses 7% in a session. We'd see them during panic-driven sell-offs. But we don't. Margin hikes show up during rallies, during upside breakouts, during moments when buying pressure threatens to push prices through uncomfortable levels. That asymmetry, more than any single chart or data point, is what fuels suspicion. Now, to be fair, there's another interpretation that deserves serious consideration. Grady's argument that silver, in particular, has taken on meme stock characteristics isn't entirely wrong. The price action in late 2024 was extreme. 7% intraday swings are not normal. They're not healthy. They're not sustainable. Markets done tea function well when price discovery turns into a game of hot potato played by machines. From that perspective, margin increases aren't suppression. They're correction. They're the system defending itself against irrational exuberance. And there's truth there. FCMs aren't villains for looking at their books, seeing leverage stack up, and deciding they don't want to be the last ones holding the bag. Their job isn't to protect traders from losses. It's to make sure the clearing system survives. This isn't some abstract risk. We've seen what happens when counterparty obligations fail on a large scale. In 2007 and 2008, participants with commitments they couldn't meet simply walked away. The institutions left exposed collapsed. Bear Stearns, Lehman Brothers. The contagion that followed reshaped the financial system. Margin requirements, imperfect as they are, exist precisely to prevent a repeat of that kind of cascading failure. But here's where both explanations, suppression and risk management, miss something crucial. Neither fully accounts for the physical market. While futures traders deal with margin calls, forced liquidations, and algorithm-driven volatility, the physical side tells a different story entirely. Central banks keep buying. Mining companies continue to limit hedging. Refiners report delays. Premiums stay stubbornly high. None of that changes because margins go up on a futures contract. The paper market can thrash around violently. The physical market moves to its own rhythm. And that's why, despite the margin hikes in 2011, despite silver's collapse from 50 to 30, the story didn't end there. Silver eventually recovered. Gold eventually pushed to new highs. Fundamentals have a way of reasserting themselves, even if it takes longer than most people's patience allows. You can manage leverage in the futures market. You can cool speculative fever with higher collateral requirements. But you can't print silver. You can't conjure supply that doesn't exist. And you can't indefinitely suppress a market when the underlying physical reality refuses to cooperate. So what should a serious observer take away from all this? First, margin increases are real risk management. The FCMs weren't wrong to protect themselves. The CME wasn't wrong to respond to extreme volatility. Second, margin increases do have suppressive effects. They break momentum, force liquidations, and cool rallies, especially during bull markets. That pattern is not accidental. Third, none of this alters the longer-term fundamentals. Central banks are still accumulating, supply remains constrained, industrial demand continues to grow. And fourth, the most important point, the gap between paper and physical is the real story. Futures traders can be shaken out. Speculators can be forced to exit. But the buyers taking delivery, the ones moving metal into vaults and holding it, aren't going anywhere. They're not subject to margin calls, and they don't care about intraday volatility. So when the next margin increase comes, and it will, the informed observer won't panic. They'll recognize it for what it is: a system managing leverage in an increasingly unstable environment. Not the end of the bull market. Not proof that the bears were right all along. Just turbulence. Painful for those on the wrong side of leverage, largely irrelevant for those holding the physical asset. In the end, futures contracts are promises. Margins are collateral backing those promises. And when promises start looking shaky, the system moves to protect itself. Physical metal doesn't make promises. It doesn't rely on counterparties. It simply exists. And that, more than any margin requirement or policy statement, is the truth sitting quietly beneath all the noise. The question was never whether to believe the official explanation. It was whether to understand what lies underneath it. Now the mechanism is clearer. The players are visible. The risks are better defined. What remains is deciding how to position yourself in a world where paper can wobble, systems can strain, but physical reality has a way of asserting itself in the end.